Hey, good morning, everybody. Welcome to this Wednesday, September 27th, 2023 edition of Trading Places Live here at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist at Earnings Beats, and I'll be your host for the next 30 minutes. As we take a look at the market action, the breakdown yesterday of the S&P 500 below 4,300. My worst case scenario back in July was 4,300. I did not believe we would violate that 4,300 level. We did it yesterday. There is some good news. There are few different silver linings, but price action is price action. We really have to respect that until the market can prove otherwise. But we got some things we can talk about. We got positive divergences. We've got the end of the historical bearish period from July 17th to September 26th. Now we're looking at a much more bullish period from a historical perspective from now through really the middle part of January. The best time of the year is actually the end of October. I think it's the October 27th close to the January 18th close. So just like we've been through this rough patch for the past couple of months, we actually are starting to move into friendlier waters, calmer waters, at least again from a historical perspective. So that's a good thing. We got the put call ratio that continues to be really elevated. And we know historically that these readings in the range where they are right now has marked some very significant bottoms in the past. So we got a lot of different factors, I guess, coming in together here, which makes it a little bit of a confusing picture, but at least we do have some silver linings out there, and we can talk about some of those a little bit more later. Let's go ahead and move on. A lot of key economic reports out tomorrow, by the way, including the Q2 GDP, the final Q2 GDP. Remember, one of the things that the Fed alluded to when they talked about, not as many rate cuts in 2024, cutting only twice. They're now expecting only cutting twice as opposed to 4 times. One of the things they talked about was the economy, which has continued to remain strong. Now, their definition is strong and my definition of strong might be a little bit different. I think the market's still continuing to hold up. I'm not sure that it's as strong as they make it out to be, but it is what it is. The market's reacting to the next story by Fed Chief Powell. So now we've got different expectations than we had a month ago, and I think you're seeing some of that priced into the market. Of course, initial jobless claims will be out tomorrow. There will be some other reports as well. Wanted to see on today, I thought we had a couple of readings out today as well. Well, durable goods. And actually, durable goods is already out this morning. So let me give you those numbers. First of all, durable goods can really fluctuate big time from month to month. So you really need to look at these over, smoothed out over a period of months. I don't spend the time. I don't think durable goods is one of the bigger economic reports that the market looks at, mostly because of that volatility. Anyhow, new durable goods orders did rise 0.2%, and that's for the month of August. Consensus estimate was for a decline of minus 0.3%. So a little bit better news than expected. If we strip out transports, the number came in at 0.4% positive and was supposed to be positive at 0.2%. So again, positive news there. To give you an idea of the volatility from month to month, last month or the previous month, July, was revised lower from minus 5.2% to minus 5.6%. So those are the kind of jumps that we can see from month to month. Anyhow, that was really the big news out today. And then again, tomorrow, GDP, initial jobless claims. We'll also have pending home sales coming out at 10 a.m. So 3 pretty big reports that I think a lot of traders will have their eyes on. So definitely keep that in mind. As far as earnings go, let's see. So today's earnings, we do have Micron reporting. That's after the bell. Paychex reported before the bell. They came in, they beat earnings expectations, $1.14 versus $1.12. Jefferies Financial Group reporting after the bell. and not a whole lot more of companies that you're probably aware of. So I'll pass there. Yesterday after the bell, Costco reported, talked about Costco and said how good their report, or excuse me, how good their chart looked. Well, their report was strong as well, at least on the earnings, came in at 486 versus 471. I'll take a look and give you an idea of how they are reacting to that report. In a good market, I would have expected a very strong reaction. But in this market, down almost 2%, down $10 from 552 and change at the close yesterday to 542 and change this morning. So we'll see how it continues to evolve. But it looks like maybe it's in a range from about 530 up to about 570. So it just seems like we're moving more toward the lower end of the range. I don't think this is necessarily a negative. I would be more concerned if 530 is lost on a close. Also, one thing before we get going and take a look at what happened yesterday, we do have a trading room that we are opening today again at 10 a.m. It's always Wednesdays at 10 a.m. Eastern. So right after this show, about 30 minutes after this show ends, we will start our live trading room today. It's going to be an interesting day. Obviously, because we had a breakdown yesterday below 4,300 on the S&P, but we're showing futures up, which normally, that's not the kind of capitulatory move. You want to see a new low. You want to see the market draw in new sellers, and you want to see the market really stretched, which I think it already is. So there's a lot, today could be one of those days where we're leading toward capitulation. And even though we're up a little bit in the morning right now with futures, we could see it turn back lower again, and could be a significant decline based on what normally happens when the volatility index is rising and you start to lose some key support levels. So I'm a little nervous in the very short term about maybe some additional move to the downside. But as I mentioned at the open, the top of the show, you've got positive divergences on the 60-minute charts. We're now in a more positive time frame for equities historically. And then throw in the equity only put call ratio, which everybody seems to just be jumping in on puts like there's no way for this market to go but down. And that can trigger a big recovery in a short time. So where do we go today? That's a really good question. I think there's a lot of risk right now on either side. I've still got my bullish vibes that tell me this thing could jump at any moment, but I also recognize when you lose price action, you have to maybe step back and think about things a little bit before you decide to commit. My feeling is that if you're on the sidelines and you're thinking about long, you don't do it all at once. It would be great if market just takes off from here, but I think you have to be prepared for further downside after yesterday's breakdown below the 4,300. But that's just my opinion. We'll see how things transpire over the next couple of days. All right, let's take a look at what happened yesterday. We've got the Dow Jones Industrial Average, which fell over 1%, 1.14%. S&P falling 1.47%. NASDAQ falling 1.51%. Mid caps 1.55%. Small caps 1.29%. Transports minus 1.87%. Transports taking another big drop, breaking the new lows again. So that selling that we've seen, talked about this yesterday, just didn't look like anything on the chart was telling me that this is it. And so we fell a little bit further yesterday, back below, comfortably below 15,000, down to 14,819. So transport's obviously not looking very good. The NASDAQ, I'm still looking at the NASDAQ versus the S&P 500. Remember, the NASDAQ is much more growth oriented. And I know a lot of the talk, even a few days ago to a week or two ago, I talked about the 10-year treasury yield going through 4.35% as a potential catalyst to drive the market down in the near term. And that's really what we've seen since the Fed meeting. We've seen rates continuing to move higher. And as a result, a lot of the stocks have moved down. But I want you to also think about the fact that the 10-year Treasury yield was at 4.33% back at the October 2002 low. And when it got back all the way to 4.35% in August, we were many hundreds, almost 1,000 points off of that low from last year. So for those who are arguing that higher rates cause the stock market to go down, I have news for you. Historically, higher rates tend to send stocks higher. And the reason that is that normally rates go up because of economic activity, strengthening, or expected to strengthen. That's normally when folks sell bonds. They want to get out of bonds to get into stocks. And when you sell bonds, yields go up. There's that inverse correlation. So when the economy is expected to pick up or is picking up, usually the stock market outperforms the bond market. And as a result, you see that rotation, selling bonds, buying stocks. That's the normal rotation. And from a common sense perspective, you might think it doesn't make much sense, because when rates go up, you think that's going to choke out the consumer and so forth. But what it really means is the consumer can deal with higher interest rates, at least in the short term, at least to a certain level. I mean, I agree. You get rates back up over 5%, 5.5%. I mean, the more it gets above 5%, I think the cloudier the waters get. We're not there yet. We're still sitting about 4.5%. I think the market can handle 4.5% rates. We've been spoiled since the pandemic with incredibly low historical rates, getting mortgages and so forth at levels that we hadn't seen since the 1960s. And so we had a lot of cheap money for sure. And as a result, there was a lot of folks that were able to get into mortgages a lot cheaper. But now we got different environments. So far, I mean, for the most part, the consumer seems to be handling all of it. And so I look at a couple of things. Number one, the NASDAQ overall has been performing better than the S&P 500. If we're looking at a recession near term, which I don't believe we are, but if we're looking at a recession near term, these higher growth oriented stocks should be getting tossed out faster than the S&P 500. NASDAQ should be moving down more than the S&P 500. That's not the case. And if you look at a longer term or even just an intermediate term, XLY, XLP chart, discretionary versus staples, we see overall pretty good move to the upside, supporting the stock market to go up higher. The XLY, XLP, I don't believe, we'll take a quick look at this chart. I don't believe, it hasn't lost the August low. So and we have been coming down pretty much since the Fed meeting. And then, I'm a little nervous because we saw this scenario in August of 2022. I've been talking about it. I don't want to spend a whole lot of time, but the character of the market changed after the Jackson Hole speech a little over a year ago. I'm not ruling out the possibility that the market has once again been kind of taken by surprise by Fed Chief Powell and some of the new language that he's now talking. I don't know, but I do think that's a possibility. And that's why, can we get back through, well, we'll go back to the charts, but the S&P 500, can we get back through these moving averages? I think we're going to have a bounce, and I think we'll probably get back up to 4,400. I don't know if we go to 4,200 first, but I believe we're going to go back to 4,400. I think ultimately we're going to go above it. But the question is, and I've had some members write to me and ask me, about my forecast, and has that changed? I really want to see how the market reacts. I need another couple of weeks probably to digest what's going on since this Fed meeting. Could it be another Jackson Hole kind of thing where we go down for an extended period for a little while, or an extended amount for a little while? I mean, I could see at this point, I would say that the trading range for me right now is probably as low as 4,050 to the downside, which is another couple hundred points, and probably these moving averages back to the upside, which is between 44 and 4,500. So you've got maybe a couple hundred points upside, couple hundred points downside, but it's the fear of what might happen with the break below 4,300 that has me a little bit more nervous in the near term. So I'm not ready at this point in time to try and give a forecast because I need to see how this plays out. Also, the next rebound, it's going to be important to see what leads on the next move to the upside. Do we turn more defensive as we move back to the upside? I don't know that that's the case. And I think you'll see what I'm talking about when we take a look at these sectors and industry groups. So yesterday, all 11 sectors were down. Which was the worst? Utilities. Now, there's, you might think, well, it should have been aggressive groups. These rising rates are bad for utility stocks because their dividends, when interest rates are low, the dividends on many of the utility stocks are good for those who are seeking dividends, the dividend-oriented traders or income-oriented traders. When you get a 10-year treasury yield that's getting up close to the yields on the utilities, that's when you start to see money flow out of the utilities and into the more, the safer 10-year treasury. And so for that reason, utilities can react pretty negatively to rising rates. And you've seen that really over the past several months. Utilities have been horrible. And this 60 to 62 area is pretty key support area on the XLU, going back further than just this 6 months. Discretionary down almost 2%. Technology also down, well, both of them down about 1.8%. Look at the industry groups, though. Diversified REITs down 3.7% yesterday. I mean, and then multi-utilities, the second worst group. And I look at this, and these are both defensive groups. So as the market gets hit and we start losing key levels, the normal response is on a relative basis, defensive groups normally would do better. They're doing worse. So when I talk about confusion in the market, I'm not talking about, because I'm bullish and the market's going down. I'm talking about the signals that the market is giving. I wouldn't exactly say that these signals suggest sustainability to the downside. And so if we get a rebound and we immediately see money rotating back into those aggressive groups, it's going to look more bullish to me, and especially going into the bullish fourth quarter. This is the most bullish quarter by far of the calendar year. Hard for me to be bearish going in. I can be short-term bearish, and at 4,300 level, let's get back up above 4,300. That's the first step. Maybe we'll do it at the open. I mean, it's going to be, probably close. But do we go through 4,300 or we turn back down? I don't know. And then the other industry group, broadline retail. And I'm looking at this chart, and I see, if we go back to July and early August, a number of lows just below 2,700. And we're at 2,725. And this is a pretty big group. Of course, it houses Amazon. And Amazon obviously has turned lower. A lot of the FANG stocks have turned lower, but they haven't exactly been leading the move to the downside. Many holding on to their August lows. So again, mixed signals there. You would think, hey, if there's a recession coming, these big companies are not likely. Maybe they've got the brand and the staying power to hold up through a recession better than others. Maybe that's what the market's saying. But overall, I'm still seeing mid-cap growth doing well versus mid-cap value. I'm seeing small cap growth doing well versus small cap value. And so again, the signals don't really line up to support a big decline. But then you have the Fed and what we've been doing since then. Again, kind of a complicated mess. I'm trying to walk myself through it right now, so it's hard to walk you through it. But I'm going to continue to look at it and watch it and see how this evolves. And I think we'll get a clearer picture here as September ends and we get into the early part of October. So we may just have to be a little patient there. And you might just have to accept the additional risk that's out there in the market right now. All right, moving on, 10-year Treasury yield. So let's get an update here, make sure we got the latest. We've got the 10-year Treasury yield down today about 5.5 basis points, back down close to the 450 level. I think we'd probably have to move back down below about 433, 435. That was that breakout, the double top. Also, gap support is right around that level. And the rising 20-day EMA currently at 4.36. So all of this comes together. I think as long as we stay above it, there'll probably continue to be talk about higher rates. And if we get back below it, I think that could be a catalyst to really drive the market back to the upside. We'll see how this one unfolds. S&P 500 yesterday, it's been breaking down below this neckline again. I'm not a huge fan of breaking below an upsloping neckline, but it has now broken below each of these price points and the 4,300 level. And if you're not aware, let me just go back 2 years so that you can see the level I'm talking about right here. This was important. This was probably the most important price support level on this chart, in my opinion, because it was the most important resistance area when we were in the bear market in 2022. So here was move number one. Here was your rebound. There's your higher or your lower high. Here was your lower low. Here's your next lower low. Actually, here is ended up being the next lower low. Here was that rebound. So 1, 2, 3, 4, 5, back down to this lower low. So that was the range. When we started moving up here, of course, I was very bullish because of some of the under the surface signals. And again, trying to call the market bottom based on price action alone is really hard to do. I mean, you can get short-term signals, and there was one. That was when the September CPI came out in October. It was really bad. High number, much higher than expected. We gapped down and we had a bullish engulfing candle on increasing volume. That was the reversing candle with a positive divergence in play, along with all the signals that I had that suggested to me that we were done. We were going back to the upside. So I was very bullish. Well, I started off being bullish back in June. And then when we had this recovery, I just kind of doubled down on my bullishness, and we did rise off of those lows. But for technicians looking for price confirmation, honestly, in my view, it didn't really occur until we got through 43.05, because this broke the downtrend. Down, up, down, up, down, and then we're in this range until either this high is cleared or this low, we see a breakdown. Until that happens, that's the trading range. And that's where we're in. We broke out above it. Notice we came back just below 4,300. As that 4,300, here's 4,300 over in January. That was the breakdown there of a head and shoulder topping pattern. And we go back 3 years, I think you'll see it a lot better. We did have a head fake to the upside. I think a lot of that was options manipulation. But here was that, what I considered a very significant topping breakdown. And even in March, when we got to mid-March, I said, okay, expect a bounce back rally because of options, option expiration week. We ended up extending it a little bit longer, but then back down we went. And I mean, you could follow my blogs and my shows and everything back in the first quarter of 2023, but I was not trusting that move to the upside at all. And for those who think I'm a perma bull, if you go back and follow me in the first 5 or 6 months of 2022, you'll quickly find out that's not true. So, you know, I try to be objective, but I'm objective realizing that the market normally goes higher much more often than it goes lower. And that's based on the long-term chart, the perspective 100-year chart that I like to show from time to time. Anyway, here we are breaking back below 4,300. So that breakdown, and maybe it'll just be a head fake. Again, there's still a lot of silver linings out there, but I'm hoping it does that we don't bottom with a gap up today and a move back to the upside, because those are the hardest to trade, because you're expecting new lows. And if you just gap up and take off to the upside, that's going to make it much more difficult to jump in. I don't know, I don't want to get too far ahead of myself. Let's see how today goes. NDX NASDAQ 100 is finally moving down below. We finally had a lower close or open than we saw previously. So while the S&P broke down, let's call it 4 or 5 days ago, we're now just getting this breakdown on the NASDAQ 100. I would say this 14.5 is a pretty big level. And if we can't hold there, I'm looking down to maybe 13,750 or so. So pretty big day coming up on the NASDAQ today. IWM, interesting thing here. When I'm looking for a reversal on a daily basis, I'm just looking for a higher high to print. I want you to look at the last 2 days on the IWM. So the high on Monday, the high on Monday was 177.03. What was the high yesterday in the morning when we took off? 177.02, 1 penny below. I don't make this stuff up. Sometimes, and you can see we've now been in this pattern for quite a while with only maybe a couple of days, maybe 2 days, maybe 3 in the month of September. We've only had maybe 3 days where we've seen a higher daily high than the prior day. So it has been a brutal month. It's been straight down. Got to break that trend for sure. You got to get through the prior day's high before you can even consider the possibility of an uptrend, right? You have to have a higher high before an uptrend can even be an uptrend. So that would be the first thing short term to look for, would be to take out that 177.0203 level. Today, we're probably going to open up 175.30, or at least based on what I was seeing earlier. We can take a look at the IWM, see if it's changed. 175.61. So now we're up about 0.75%, but still a far cry from the 177.0203 level. Again, we'll see what happens there. Transports. Bad day yesterday. Hold on. Okay. Bad day yesterday. You can see the breakdown. Big problem is that as we were breaking to new lows, still not seeing a positive divergence there. Also, probably that -2, that was back where we were in March on the PPO. So that's how we got stretched during that ABC period. Here, I don't know, this is kind of almost like an A, not really much of a B, if you want to call it that, I guess. A, B, and now maybe we're in a C. But that's when we saw the PPO drop to -2. Are we going to see it that far down again? At this point, it's signaling that maybe we will. All right, chart of the day. First, I just want to let you know, if you go over to Earnings Beats, scroll down, make sure you sign up if you haven't already for our Earnings Beats Digest, published 3 times a week. This is a free newsletter, no credit card required. Just simply type in your name, email address, hit that subscribe button, and we'll make sure we get the chart of the day out to you. What I sent this morning to our EB Digest folks was a chart of the S&P 500 talking about capitulation, talking about that October low, where you see the move down and then you come roaring back up. Positive, well, there was a positive divergence, but a very solid hollow candle. We saw buying all day long, and look at the volume tick up versus these down days. So it's just giving us a sign that, hey, at the open, there was a little bit more panic, a lot of folks throwing in the towel. And when they did that, market makers began providing liquidity and started buying everything that they could buy that day. That's what capitulation looks like. Doesn't always come in the form of a big hollow candle engulfing. Sometimes it's like this candle right here, where you see a move down, you have a little bounce, and then you go down and you have a false breakdown where the tail goes below the prior lows, but then we see buying on the way back up. Here, volume ticked back up again. Wasn't a huge volume day, but it was probably at least average, if not a little bit above average, and we saw a reversal. Notice that tail held as support. Here we come down. Look at this volume picking up 4 billion shares that day. One of the biggest volume days of the year on March 13th. And we didn't actually get below the December level, but we neared the December level, and we finished up almost 50 points, or maybe it was 50 points off of the low of the day on that kind of volume. This was a very volatile day. It's a high wave candle. You got a lot of intraday movement, and a lot of times that can signal a top. And the other thing is watch the VIX. And that was one thing that I pointed out as well. Keep an eye on the VIX. And the reason you want to keep an eye on the VIX is because when you start seeing these long tails to the upside, that's where the VIX is going up intraday, but can't sustain those gains, reversing. And a lot of times you'll see that it tops. Here, look at that big move up, left the tail, came back down. Here, false breakout above that prior high, back down. Here, big reversal. Even this one, look at that big reversal. They start to signal here was a big reversal, and then the VIX comes down, big reversal, VIX comes down. We're not seeing a reversal yet. That's why if the market goes up and we see the VIX, I mean, a perfect scenario for me would be a big intraday drop, recovery by the end of the day, and to see this tail going up somewhere above 20, maybe even above 21, but coming back down and closing below 20. That would be the VIX signal that maybe we're at a bottom. But also, as I mentioned, we want to watch these capitulatory candles as we go down. Yesterday we closed on the low. Now, have we seen markets close, or the market close or start to trend higher off of a weak close? Yes, it does happen from time to time. Here we were going down. All of a sudden, next 2 days we shot up. Even here, come down, we're closing on the low. Of course, we're above the 20-day, little different market then, but we bounced off of that. Here, we started to turn lower. We weren't at a low, but it certainly looked like, hey, we're rolling back over. Next day, we gap up. We're off to the races. So can it happen? Could we see a gap up today and just an explosion back to the upside? I certainly would not rule it out, especially how stretched we are in the options world. But with the breakdown 4,300, what do you do? Everybody's got to make that choice. For me, I got very defensive at yesterday's close, seeing that move back down below 4,300, seeing weakness into the close. I'm still looking for the opportunity to get much longer on a leverage from a leverage standpoint. That's not normally the candle to do it on. To do that and then to hope we're going to gap up and move up, I don't know. We'll see. Anyway, 3 minutes into the market. So I do want to close this down, but let's take a look and see what's going on so far. Well, we've got the Dow up about 1/4%, S&P up about a third, a little more than a third of 1%. NASDAQ up almost 1/2%. Small caps, though, the 600 small cap index up almost a full percentage point this morning. We'll take a quick look because I do like to follow that IWM. And right now we're up at about 176.08. So that is up about 1%, still with a lower high. Don't be surprised if after this gap up, we make another push to the downside. But at least for now, things are definitely looking up. But let's see if we can get a little bit more steam behind this move to the upside before we get overly aggressive. That's for sure. Anyway, that's it for me today. Remember, at 10 a.m., we have our live trading room coming up. So if you go over to Earnings Beats, what you want to do is click on this join now, and you'll be able to sign up for a 30-day free trial for our entire service. And that'll get you into the room not only today, but for the next 4 weeks until that trial expires. So if you want to try it out, today's a pretty interesting day, especially for a trading room. You better, from a risk perspective, you better put your big boy pants on coming into the, to think about trading, because the volatility as it's been rising, that can trigger both big moves to the downside and big moves to the upside. And we'll talk about some of that during the trading room session today. But again, that starts in about 26 minutes. So hope to see you there. Everybody have a great day. Just be careful out there. It's a really tough market right here at this level. Have a great day, everybody. Happy trading.